Starting. All attendees are in listen-only mode.
Well, good evening, everybody. This is the mid.
I didn't know I raised my hand. I have no idea what I'm doing on the screen.
All right, Ken, you should probably go ahead and mute some of our guests.
I'm going to. I forgot to mute her before I
It's all
put
right.
the hand down.
Don't worry, Leslie. We'll keep the microphones open if a situation comes up as we go here tonight. Well, welcome everybody to the July 2018 Roundtable. My name is Mark Robertson. We've been doing this now for 8 years, so this is something of a birthday party or anniversary party. I'm joined here tonight by my dear friend Ken Kabula and on one of our special guest nights, Herb Lemkool. Both Cy and Hugh are unable to join us tonight, so it's going to be the three of us. But we didn't have a cake, so we thought we would take and celebrate with the Justice League photo here on the cover page. Ken said no costumes 8 years ago. I don't listen very well. He knows that. He doesn't listen to me very well either when I want to go to places like Punxsutawney. But we could have put the heads on just about any one of the bodies here, and it would all work out. I did choose mine for the sleek speed and the freedom label there. We've got Cy Lynch is there as wisdom. He's got the nice red cross there. Hugh McManus, power. He's been one of our leading contributors over the years. I gave Ken the duty slot, and I like that picture of him from is that from the Wall Street Journal or the New York Times, Ken? It's one of those.
That's from the Wall Street Journal, yeah.
It's from the Wall Street Journal article. The next one was we had to put the damsel in one spot among the seven, and you guys can figure out the rest of that one. That's Kim Butcher of Evansville, Indiana, in the truth slot as Wonder Woman. Shrek there is Nick Strategos from Pittsburgh in the Batman or Justice slot. And also joining us here tonight is one of our favorite guest nights and just a wonderful educator and volunteer here in Michigan, Herb Lemkool. Special welcome to you, Herb.
Thank you.
So there's a few people that are not with us here tonight that we should mention. Again, we've already mentioned Cy and Hugh are unable to join us, but we've had contributions from people like Susan Michelek from Wisconsin, Ann Manning from Houston. Again, Matt Spielman, who is now relocated to, I believe it's Dublin, Ireland.
Dublin, Ireland. Yes, he is.
Probably part of the new part of the company over there for Delphi. And again, we just want to basically give a nod to our audiences. Our audiences have been a part of this. We keep the microphones pretty open. We stick around for a Q&A afterwards. But this program really is intended to be just a moment of sharing, kind of exploring of ideas. And we've had a lot of fun over the last 8 years. Any words from either you or Herb, Ken?
I never thought that we'd still be doing this 8 years after we started it, Mark. It's almost as much fun today as it was when we first put it together. And I think we've come up with some great ideas. And more importantly, I think we've demonstrated that a bunch of well-meaning amateurs that pay attention and do their homework can match the market and in a lot of cases actually beat the market. Why don't you move into our results page here to show folks how we've been doing for the last 10 years.
Okay, we will do that. First, we got to do some legal beagle paperwork. Again, just stopping for a second to remind everybody that, as always, no investment recommendation whatsoever is intended. We do this, as Ken just said, for demonstration. We're demonstrating a way, a method, an approach to discovering the best companies, better companies at better prices. It's really that simple. And the companies that we air out and explore here, it's all part of demonstrating a process and a philosophy made popular by the modern investment club movement. And that's the approach that we follow. Again, do your own homework. This is a demonstration. If you do want an email reminder, if you have somebody that you want added to the reminder list, nkavula1@comcast.net down at the bottom of the page. If you have follow-up questions or want copies of slides, that's my email address, markr@manifestinvesting.com, and drop me a note. Here's our standing agenda. It's been the same for 8 years now, 96 meetings, 96 months. Again, welcome, especially if you're here joining us for the first time. A special welcome to you, and welcome to everybody. We will take a look at performance. We have had very strong performance. We want to continue to understand what we're doing and continue to explore the things that have been working, and we're always searching for improvement. We're going to look at some quick challenges to the portfolio. By challenges, we mean stocks that should be considered as potential selling candidates to close out the positions. Got 4 presentations, a quick look at Cognizant technology, because Cy Lynch, even in absentia, is submitting Cognizant for consideration. Herb's going to cover Ionis Pharmaceuticals, Ken, Coherent, and I'm going to cover Skechers because it's all about the shoes. And we'll do an audience poll, and then again, we'll leave it open for Q&A at the end. We try to wrap this up in about 75 minutes, but we tend to stick around and answer questions. Ken, do you want to describe what it is we're doing here? What we do?
Yeah, when we started 10 years ago, we wanted to put together a tracking portfolio, a list of ideas that people could consult. We wanted to keep that list current, so as long as the idea was fairly decent, we thought it should stay on the tracking list. And when the idea got to a place where it wasn't returning the kinds of returns we thought it should return, or when the fundamentals were falling apart or the quality was falling apart, we wanted to drop it from that list. We do it by each one of the nights presenting their single favorite investment opportunity. We're following the words of George Nicholson, who said 20 to 25% of your portfolio could be in non-core holdings, non-traditional kinds of investment. That means occasionally we're looking at companies with no earnings. We're looking at emergent companies. Occasionally we're looking at things that a standard better investing investment club would kind of giggle at if they brought it in front of the club. Our goal is to have a long-term return that beats the market over time by at least 5 percentage points. We think if George Nicholson were alive today, that would be the goal that he would set. That was the goal that he set for investment clubs way back in the 40s when he said investment clubs should do 15% on an annualized basis. That's beating the market, beating the average market by 5 points. With modern tools, especially with computers and with the availability of information, we think that goal, if Nicholson had survived until today, we think that goal would have been modified to beat the market on any given year by at least 5 points versus a broad index. It doesn't have to be the Wilshire 5000. It could be the Vanguard Total Stock Market Index. It could even be the S&P 500 index, although that's a little bit more narrow. We've noticed that all of those types of indexes tend to track reasonably close together over long periods of time. We're also interested in accuracy of 60 to 70%. We'd like 60% or more of our choices to pass this benchmark of beating the market by 5 points. So the next slide is going to show you how we've done over 10 years. Go on, Mark. Ta-da!
Actually, I'm throwing you a curveball tonight. First of all, I want to know, can I bring Bitcoin as a non-core investment sometime?
What? We'll boo you off the stage, okay?
All right, 8 years. Just want to make the point that we've been doing this for a while. 441 buys, 215, so that's a lot of decisions. But the return that has been achieved by the tracking portfolio, this is fully accounting for dividends and splits, is 18.2%. We've had a lot of fun over the years. People will recognize some of those images, some of the people involved. Susan Michalik is there on the far right, along with Kim as our guest damsels. We've had a lot of fun with the Olympics. Our performance has crept up above the line. We have the Stanley Cup on our page. A lot of good fun going on there. And then many people will remember Hugh McManus's timeless presentation about investing like Spock, not like Kirk. And that was a good one. Some good, clean fun. I thought we'd just take a moment before we break into the performance to take a look at what the best performing selections have been year by year, and where they came from. Show you a little bit about the math behind the numbers that you see. And these are still active or open positions. These are actively or presently in the tracking portfolio. So you can see, I believe that's group payments up at the top from PSI back in October, the year 2010, which was just a couple months after we got started. That's a one-time.
Global Payments Network, Mark. Global Payments
I'm sorry.
Network.
Yeah, Global Payments Network. So you can see that that $1,000 has become $5,813. All right, and that's actually beating the market by 11.6% per year. It's a 25.5% annualized total return. And so we have some fun. The thing that really gets me is as you look down that list, you can see some fairly interesting ideas. Many of them are one-time selections. NetEase down there at the number 3 position. I had forgotten that Kim brought S&P Global back in February of 2013. That's knocking it out. Hugh McManus's controversial pick of Amazon at the National Convention that year. It's actually the best all-time selection on the chart for the active companies. But you can see that the audience has been involved in 3 of those annual leaders on the list. There is.
Well, it looks like one of our annual leaders got knocked off today, Mark. The IPGP, which means it's still doing extremely well from where we bought it. Look at the average cost. We bought it at 82.37. It's still trading above 140. I didn't look at the exact price that it closed finally at the end of the day. So it still has a great return attached to it, but it's no longer that 40% relative return. In fact, I think you looked into the spreadsheet to find out what would supplant this if we did the prices at the close of the trading today. And I think one of your choices, Mercado Libre, MELI, would have been the best pick from 2016 if in fact we would have done this list as of today rather than as of last night.
And I appreciate that, Ken. I just didn't want to appear that desperate to get my name.
That's why I said it for you, Mark, okay?
So, you know, a lot of these, we've had a lot of fun with Fleet Core at the bottom. Audience seconded that one. And then, of course, Nick Strategos' presentation of Five Below. That's so far as the current leader for this year. And here actually,
I'm getting a note from our resident researcher, Len Douglas, in the Southeastern Michigan chapter. And Len says IPGP closed at 164 today. So if I look at that 82, it's still a double since 2016. You can't ask for a lot more than that when everything's doing what it has to be doing.
Yeah,
so.
That's what I thought I saw too. So some good stuff. And again, I get a kick out of the fact that the success comes from everywhere. And that's a reminder to investment clubs across the country that don't discount the ideas of your partners. Accept them and explore them completely. Here's a list of the leaders with the closed. These would be positions that we closed, basically sold over the last 8 years. And fortunately, I show up on these quite a bit. TJX was a great one from year one. Back in 2010, we had a good time with Southwest Airlines, HomeAway. I had forgotten about Cyberonics, Ken. That was a pretty good run that you and the audience had there in 2015. But some really fun ones there, including the all-time leader, which happens to be mine with Stifel Financial. That's SF. They're in the middle. So, again, the audience is getting involved here. Multiple people bringing these type of things home. Good, clean fun. And
I will remark, Mark, that we've always counseled people to hold core holdings until their potential annualized return comes down into money markets. And the only sale that I regret making over all 10 years was that sale of TJX. I still think it's a wonderful company to own today. And I think we sold it a little bit too early. We should have let it run, even though we sold it and locked in a 37% relative return. I would have liked to have seen a 30% plus relative return for 10 years. And I think it would have come close to doing that for us if we would have held on to it. The only sale that I regret, it was one of our very first sales, and we did a lot of discussion about what did the sale mean and when should we get rid of it.
Yeah, I can remember back in that time frame talking ourselves out of Costco, selling Costco, and that is still in the portfolio.
Yep.
From
Yep.
that time frame.
Yep.
Good stuff. All right, let's keep pressing on. Here is the overall over time, and again, we celebrated within the last year actually crossing that 5% advantage to the market threshold that Ken was talking about a minute ago. So again, achieving a return of 18.2% while the market's going up 12.7 as measured by the Wilshire 5000. We have beaten the market by 5.5 percentage points. That's 550 basis points if you speak that language, with about half of the selections beating the market over time. We'd like to see that be a little bit beefier, but the one that really matters is that 18.2% over time. So we like the momentum, we like the trend. Let's hope we stay in the promised land there. All right, switching gears to what are the companies that have actually delivered that performance in terms of the active holdings. You can actually look at, I believe there's about approximately 90 active positions in the tracking portfolio. You can look at them at this public link listed at the top of the page. The next line down is the legend, which basically tells you how many times everything is selected. In the case of Cognizant Technology, it's been selected 14 times, as is shown in the legend. So what we do is anytime it's selected by any participant, any knight, any damsel, or the audience, we invest $1,000 in it. So the 14 time selections in the Cognizant means that $14,000 has been put in, and it's now worth $27,000. So you can do that with any company on this list, or by referring to the longer list at the public link. So we've had a pretty good run with many of these companies. Look at Amazon. Amazon's a 2-time selection, and it's gone up nearly $10,000. There's a number of companies on here that have been quite rewarding and a lot of fun. Look at S&P Global and PayPal down at the bottom there for Kim. Those are selected just a couple of times. All right, let's go ahead and keep pressing on. I thought we would just make the point, especially since Cy wants to bring Cognizant here tonight. In his absence, we'll be presenting by proxy. But this is a look at Cognizant Technology from the first time it was added back in the first year of the roundtable. And you can see the price chart there. And those are the actual 14 transactions that have taken place over time. So when you hear us teasing Cy about his selections of Cognizant, there they are in black and white. You can see that he owns 12 of them. And actually has done pretty well. Don't let the red ink fool you. That means that most of those positions are basically keeping up with the market. All of those positions add up to an overall position, which is beating the market by a few percentage points. But the one that I find quite interesting is after the 6th nomination by Cy, all of you guys in the audience decided to second that one. That was the best time you could have selected to second the motion back in June 2013 when we're in the green circle here. That's the actual best performing lot, if you want to think of it as a lot. The $1,000 invested on that night, June 25th, 2013, is actually the top performing piece of this puzzle. And I came back a couple months later and jumped on the bandwagon, the coattails, but you can see Cy's gone back another 6 times since then. So I think that's kind of fun to notice that the audience finally chimed in after on the sixth one was a charm. All right. One of the things that we do like to do every month is follow the better investing practice of challenging the weakest return in the portfolio, the weaker returns in the portfolio, and see if we want to continue to keep these companies in the tracking portfolio. And at the top of the list tonight are Chembrex, Robert Half, and First Financial Bank shares. And these have all been actually pretty good positions, most of them gaining pretty handsomely. But with the price run up, you get a little bit of a dwindling of the return forecast. You can see we're in lower single digits, approaching zero, certainly less than the median par, which tonight is 7.1%. So we basically want to challenge those. Now, Ken, those first two are yours, successful selections, and First Financial is actually size. So we'll just do a quick audit of the three and see if we want to let go of any of the three. So here's
Well, Mark, in the last 6 months, I've owned all three of those. I have sold one of those three because not because it's not a good stock anymore, but because of valuation. In fact, it's the one that we're looking at right now. I have sold my position in Cambrex because it had made a lot of money, and the potential going forward didn't look very attractive for my portfolio. I did not consider Cambrex a core holding. I still don't consider Cambrex a core holding, but I do consider it a high quality company.
Yeah, and it really does come down to do you think that they're going to have high single digit growth or something a little bit less than that? And a little bit of weakness here would drive that return down to low single digits. I wouldn't run for the hills if I was holding it myself yet, but I would be pretty close to having a finger on the trigger.
Mark,
Go ahead.
Finish your thought, then I'll make my thought. Yeah, I didn't mean to interrupt you.
We're probably heading the same place. The one thing that bothers me greatly is the plateauing of profitability, and that blue line is flattening. So I would, in order to continue to hold it, I think I would want to see some expectation of improving fundamentals.
Yeah, my issue with Cambrex, Mark, is I bought it as a very small company in my portfolio, and I expect my small companies to do some fairly heavy lifting. So when it busted through the 12% annualized return and moved down below that, and then when the sales growth started to slow as well, notice that the sales growth forecasts for 2018 are under 9%. That's a great sales forecast for a medium-sized company, but $811 million in sales, $812 million in sales, that's just a little bit light for me as far as holding it as a small company, and that was one of the big factors that pushed me to let this go from my portfolio. And again, I want to make the point, I had made a significant amount of return from this particular small stock.
Okay. The second one is Robert Half, and that's also been extremely good to the roundtable tracking portfolio. Pretty good picture. It really comes down to a crux question that I would toss at you, Ken. When you look at Value Line, they have an average PE expectation of about 20. You can see the PE graph on the lower right. That certainly doesn't seem to be unusual, but if you look at the consensus including Morningstar, S&P, and some others, there's a little bit more modest expectation when it comes to the future PE. What would your perspective on this one be?
Well, I'm still holding Robert Half. I like the industry that it's in. Again, the sales are a little bit low for what I normally look for in a medium-sized company. At $7.4 billion, sales of 6% are more like a really big company, but this company fills a space in my portfolio that I don't have anything else even remotely similar to Robert Half. My study on Robert Half deals with a PE that's at 18, Mark, so that's pretty much in line with the 20 and with the 17 that you chose. So I'm relatively content with the stock. It's making me decent money, not outstanding money, but I'm still holding Robert Half.
Mark and Ken?
Yeah, go ahead.
It would be helpful if you told everybody what they do. Robert Half, I think, is an accounting company, and they're having trouble trying to recruit people, I think.
Well, Yes and no as far as an accounting company is concerned. Actually, Robert Half is a staffing company, and they
Staffing, yeah.
supply
Including
they supply substitutes to various types of jobs, and they do supply accountants. And you're right. One of their biggest challenges right now are finding enough qualified people to fill the staffing needs of their clients. We're facing a fairly decent labor shortage in a lot of specialized fields, and Robert Half places people that have specialized skills, so that's weighing on what their whole business model is based on. You're right.
it's
Thank you.
got to be pretty competitive too. I'm sure Herb has used some of these type of companies in the past. All right, and last but not least, this is Size First Financial. Again, a very strong performing company over the time. It's hard to beat up straight and parallel any more than this one. And again, it's not a screaming sell, but it's among our weakest. I think I would be inclined just to hang in there.
I would not sell First Financial. It sits in 3 or 4 of the portfolios that I'm involved with, and it's one of the highest quality banks that we've been able to locate. And we've done a lot of work on banks in my 2 model clubs and in my own personal club. A lot of work to identify the highest quality banks and put some money into them. We really still feel that this whole idea that banks are very undervalued is valid, and we're still looking for rising interest rates and rising yields on bonds to make the bank's business model work in a very profitable way.
Yeah, this one's pretty solid. So I mean, our weakest companies in the portfolio, this is probably a testament to the spring cleaning we've done over the last year or so. Because there's not much really wrong with the 3 of these. I do think if any of them approached a return forecast of 0, I might be tempted to do something, but I don't see it now.
Yeah, I wouldn't have any problems moving Cambridge out, but at the same time, I have no problems keeping Cambridge in this portfolio either. I think Cambridge was the #1 company in our small companies list from last October, wasn't it, Mark?
That is correct, and I mean it slowed down a bit. That's an obstacle to it going forward in this year's list. But again, that's I think we just raise the vigilance on this one and keep pressing on.
Sounds good to me.
All right. So with that, let's go ahead and bust into the stocks. I'll just make a quick one on Cognizant. You guys already saw that we've purchased it 14 times already. Cy wants to nominate it again because it is up straight and parallel. It's in a whole bunch. I think the vast majority of investment club portfolios have this company, so it's no stranger. They provide, again, not the same type of services as Robert Half, but similar type business model. They do a lot of management consulting and that sort of stuff, and IT type consulting worldwide. A lot of business in India and the United States. Here's a look at the company from an analysis perspective. Again, you're talking about a $15 billion company growing at 10%, churning in these very consistent margins in the 16-17% range. Generating a consistent PE of 16, 17, 18. Nothing wrong with this company. Up straight and parallel. A little bit of a price dip here lately, but Cy wants to throw another log on the fire. It'll make it a 15-time selection. And his point is the quality is hanging in there, even though they had a bit of a challenge with the global recession. But the price has crept up finally. We were patient. We waited through the plateau. Even though that graph looks like the return forecast has been sagging off and declining, it's not a terrible decline, and we're still looking at double-digit returns. And their business improves every day that the global economy improves. So he would like to go ahead and continue accumulation of Cognizant technology. Any questions or comments, Ken?
Well, I'd like to put a plug in. If you're sitting in our audience and you belong to a model club, Ann Cunez and myself are in process right now of collecting data from as many of the model clubs as want to participate throughout the country. We put a survey out there that you can have your club fill out, and we'll be doing a complete dive into what the model clubs hold and what their portfolios look like in the September stock up program through Better Investing. If your model club has not yet filled out the Survey Monkey survey, the latest chapter advance has a link to that survey, and you need to get one person there. It'll take about a grand total of about 7 minutes to fill that survey out, maybe not even that much if you have a statement right in front of you of what the club owns. And we'd love to have your club included in this study when we present it in September. Last time we presented this information, we found that every single model club that participated in the study, except for one, owned Cognizant technology.
Wow. All right. Well, it's among the most widely followed companies at Manifest Investing too, so we can certainly understand that. All right. So with that, let's go ahead and welcome our guest Knight back. Herb from God's country up there in Traverse City. Are you actually home now and enjoying this wonderful summer, Herb?
I am. We've had a great summer this summer. I tell you, we've been doing, I spend, 2 or 3 times a week playing pickleball. I sail on Wednesday nights. We've been doing a lot of traveling. I had a granddaughter get married in Wisconsin. So, we're just very, very blessed in what we were able to do. But I also want to say congratulations for Mark and Ken on this is our 10th anniversary. And you guys have been just icons of information, ideas, and things that we can look at and learn from. And it's been very, very rewarding for me, our clubs, and for a lot of people throughout the country.
Well, thanks, Herb. It's 8 years, by the way. 8 years.
8 years. Okay.
Thank you, Herb. Thank you.
If we make it to 10, we'll have a big blow up somewhere.
Okay, good. So anyway, I really struggled that you called and wanted me to be able to present a stock, and I really struggled with this one because it's one of those that our investment club, Cherry Capital Investment Club, has owned for quite some time. We found it because one of our members has a friend of a friend of a friend who works for Ionis, and so he said we should study it, and we bought it. And our original purchase, we made some pretty good money on it. And but then I'm going to talk to you about some of the reasons why you should or shouldn't buy a stock. One of those reasons why we own this stock is because I had a great-granddaughter who was born with spinal muscular atrophy. That's SMA. And Ionis Pharmaceutical is one of their drugs that they have come to bring to fruition is a drug that attacks and be able to help those that have this particular disease. She died when she was 8 years old. She was just a bubble. She was just a wonderful person and was loved by everybody around her. Today, if they'd had this drug, she probably would still be alive if she was given this drug when she was born. So they also are finding that fewer and fewer people in the United States are coming down with this spinal muscular atrophy. So we own the stock because of that. And then also one of our newest members of our Cherry Capital Investment Club joined our club here about a year and a half ago. His daughter graduated from college and started looking around for companies to go to work for. And lo and behold, where do you think she lands? Ionis Pharmaceuticals in California. So it was one of those things that, if you know something about the company and you're comfortable with where they're going and what they're doing, it's something you might want to look at. This company does not make a profit. It hasn't made any profit. Its projections in the future is going to be that they should be able to have a lot of companies that are going to come online to be able to make this thing work for everybody. So Ionis is just one of those companies that you got to be able to know that it does a lot of good things. Its management is really, really good. They really do an outstanding job. The leading company in RNA targeted drug discovery, development focused on developing drugs for patients who have the highest unmet medical needs, those patients severe and rare diseases. So it's really, they look at small clubs, small diseases, and then they try and find a way to be able to do it. They also are bed with Biogen and commercializing Spinraza. They're antisense drugs that Ionis discovered, and they're advancing in phase 3 studies. It's been approved by the European Union for stage 1 and 2, and I think we heard a great presentation last month about drugs and how they go through the different stages, and I thought that was very, very nice, very well done. So I think it's really important to know that. Ionis Pharmaceutical, if you go to their website, they have a couple of videos that talks about how they take the people with SMA, take them out on a surfboard and show them how to surf in the water, and it's the members of their staff that are doing that. So you just want to know, when you start looking at this particular company, in our portfolio, we call it our high risk company. And every time, if you look at your value line, they will also talk about that it's a high risk, but it also, I think, has some very high potential. If any of these drugs start to come on board, I think in 2019, they're going to start showing a profit for the first time ever. And they're projected to go up to $3.20 a share for profit in the next 5 years. So this is a company that's very risky. We know that it's risky in our portfolio. We've had some discussion within our club about whether or not we should sell it, and how we should handle it, where we should go with it, and whether or not we should wait and just hold on to it. Our club is known for holding on to stocks and probably longer than we should, but yet it seems to prove beneficial. So, Ionis is just a great little company, and I would recommend, this, when I start looking at the value line, when you start looking at projections, they're looking at a 70% price at the low, which is a 50% gain or 11% return. Their high price are going up to $115, 150% return, or 26% total return. So their earnings per share are projected to go up even with value line. The book value is projected to go up. Capital spending has been pretty stagnant at 15 cents a share. So I see their revenues almost doubling from 18 or more than double. So I think this is a company that could be very, very exciting, also nerve-wracking, and also one of the reasons why you may or may not want to own this company, but I sure would recommend do your own homework. This is a company, like I say, is highly risky.
Okay, thanks, Herb. Yeah, I think you have to look at this kind of like a young Amgen. I can remember back in the early 1990s, we had a company called Aguron Pharmaceuticals. They were dealing with cancer cures or drugs, and they were eventually bought out about 8 years after we bought it by Johnson & Johnson and some Japanese company. So that type of thing can happen. So you have to kind of regard it as a potential Amgen, but in the early days. And like Herb said, if this thing takes off, it could be extremely rewarding. If it doesn't, much less so. But it's the type of thing that can be fun. It'll be interesting to see what Mr. McManus will have to say about it in the future, because I'm sure we'll bring it up again.
Well, when you look at the dashboard, it's got a par of 19.8% on your particular dashboard and manifest. But your financial strength is weak, and earning stability is not there, the quality is not there. So it's really quite a risky particular company, but their growth could give you some great growth at 24%. So this is a really small company, and so it doesn't belong in everybody's portfolio, but it could be in anybody's if they want to look at this as a highly risk company. That could, the bigger the risk, the higher the gain, the opportunity.
Yep. When it works out, it could be pretty spectacular. All right. Thanks, Herb.
Yep.
All right, Ken, you can take us away with Coherent.
Okay, let's start before we go to the first slide. Let's start with how I found Coherent. I'm a big fan of 3 different screeners. My primary screener is from Manifest Investing, and I use that one on a practically weekly basis, sometimes twice a week basis, to try to identify companies that I might be interested in buying or selling. But I also like the screeners that are available through the SSG Plus. That's the online tool. The Plus is the more robust version of the online tool, and it has a screener with some preset screens, and I really like their preset screen for small companies and for value companies. So I use those on a fairly regular basis. And then the third screener that I really use a lot is the Value Line screener. It has dozens and dozens of criteria that I can put onto it, and I can really kind of pinpoint exactly the kind of stock that I'm looking for when I'm using the Value Line screener. Well, I spent about an hour and a half today in the morning looking for stocks to present to the roundtable, and one name kept appearing, Coherent. It appeared on all of my screens. It appeared on the value screen and the small company screen and the high quality screen in the preset screens from the SSG Plus. It appeared in the top 1% of the Manifest rank stocks. I looked at it very carefully, and then I did some screening in Value Line, and lo and behold, it appeared in that list as well. So I was very interested, and I started looking at their website and reading a little bit about it, and here's what came up. Let's go to that first slide, Mark. Coherent is the leader in photonics, and photonics is a fancy word for light. They use light in a lot of different ways, mostly as lasers, and they do all kinds of things with these lasers. Let's go to the next slide, Mark. If you look, this company does most of its sales outside of North America. This is not a typical American company. 63%, almost 2/3 of its sales are to Asian countries. A big chunk of that in China, obviously. 16% in the US, 18% in Europe, and 3% in the rest of the world. So this is not a typical American company. Coherent operates in 4 main businesses. They operate in microelectronics. And when you think of this, think of making chips. Lasers are very widely used in creating chips in various different kinds of companies. They're used especially in creating these organic light emitting diodes, these OLED chips, as you they've come to be known. We've talked about that before with companies like Universal Display, which actually does the creating of the chips, and they're using tools from companies like Coherent to make these chips. That happens to be a very fast growing business, and the growth for Coherent versus the market is spectacular, and they hold the first position among all their competitors in that particular segment of the business. The next segment of their business is material processing. And they're doing things that kind of Star Wars kind of things with lasers, using lasers to engrave, to cut, to weld, and that's what we've come to think of lasers at. We don't have a wide-ranging idea of lasers. We think of them zapping things. And again, a very strong growth versus the market for this business for Coherent. They're either second or third, depending on the business we're talking about, the sub-business that we're talking about. And notice there under competitors, you see IPGP. We've talked about IPG Photonics this evening before the meeting started. They took a really big hit today in the stock market. And Coherent also went down significantly today. I happen to think it's in sympathy. A lot of times companies that do the same kind of thing as a company in trouble bubble tend to move in the same direction when there's a big hit on one company. I think Coherent had those issues with its price today because of the problems that IPG reported. I'm making the point, I guess, that Coherent competes with IBG, but just in one of its 4 businesses. It doesn't compete throughout the entire business range. And this materials processing is not a quarter of the business for Coherent. You look at the third business they compete in, that's original equipment manufacturing, components and instruments, medical things, defense things, display instruments, diagnostic instruments. Their growth is not as high versus the market here, but they do hold the #1 position versus all of their competitors. And look at the opportunities. We're talking about laser eye care, dental care. My dentist is predicting that you will see lasers in dentist's office, in the normal family dentist office, within the next 5 to 10 years. I'm the leading edge of the baby boom. I was born in 1946, and that's the oldest baby boomer there is, and I just had cataract surgery. Laser eye care was not part of my cataract surgery. Mine was not done with a laser, but the prediction is that as that surgery is done more and more and more often, the tools will improve and it will move to some laser surgery. You've already heard of things like LASIK and things like that, which already do use lasers to do the surgery. So this is a big business for Coherent. And then the last business is a relatively small and it's a relatively stable business for Coherent. They're #1 in the marketplace in this business as well. And this is dealing with research materials, government program materials, things that are used to help find out various things in science. It's called attosecond physics under growth opportunities, but it's basically materials that are used in laboratories as they try to come up with answers for all kinds of different physical science questions. So the company has a real broad base, does an awful lot of things. Its biggest business is the microelectronics, and the 2 in the middle are smaller portions of their total business, and the scientific research is a very, very small part of their business. Next slide, Mark. Again, the growth drivers that I've talked about, one of the biggest ones that I didn't talk about are these smaller geometries in silicone. What that basically means is that the chips are getting smaller and smaller, and they need better and better ways of creating these chips, and that means they're moving to lasers. They're using lasers to create these geometries. This metal cutting, welding, and joining applications are being attached to robots in factory situations. If you were to walk across the floor of an auto plant in the 70s, you would have seen it bustling with all kinds of workers. You walk across that same floor today, and there are still workers there, but now they're controlling robots, and the robots are doing all kinds of jobs that call for very sophisticated joining techniques or cutting techniques, and the laser is a tool that's being used for a lot. This OEM instrumentation, I like that last one. That last one comes from a company that Coherent purchased. It was called Rofin Sonar. And if you've been with me for a long time listening to my talks about different stocks that I like, Rofin Sonar was a local company here in mid-Michigan, and they did a lot of work with lasers with the automobile industry, but also a lot of work with cosmetic lasers, dealing with lasers to take away brown spots on your hands or different parts of your body, dealing with veins on the tops of your hands to make them look younger, all kinds of aesthetic and dermatology lasers. And that company was purchased by Coherent a couple, 3 years ago, and folded right into what they're doing. So my original idea of Rofen-Sonar is still alive. It's just a piece of Coherent. Now, next slide, Mark. I went to the value line, and lo and behold, this was a triple play. I'm looking at the price projections out for the next 3 to 5 years. The first leg of the triple play is a stock price that is under a little bit of pressure, and I translate that to the value line sheet as total returns that are double digit at the low end, and then if they're double digit at the low end, of course they'll be double digit at the high end as well. So when I see 11 to 23% annualized returns for the next 3 to 5 years, that indicates to me a depressed stock price. I'm then looking at the PE ratio at the top of the sheet and comparing it to the average annualized PE ratio, and I've drawn an arrow down to it and circled it down there so you can see it. I'm looking for a PE expansion going on, and 14 to about 19, that's certainly expansion happening. And what I like is that it's not expansion happening at nosebleed levels. These are both under 20. That's really nice. The current price is down around 160, 158, something like that. And so these PE ratios are probably fairly accurate, the one at the top of the page. The last thing I'm looking for are profit margins to increase over where they were. The actual profit margin percentage in 2017, net profit margin was 12.1%. The projected for 2018 is 14.8%. But look 3 to 5 years out, they're projecting profit margins of 17%. So I have a triple play. Now, that doesn't necessarily mean this is a buy. It just means it's a really good idea that probably should move up to the top of your Let's Study It list. So I moved Coherent up to the top of the Let's Study It list, and here's what I found out. Next slide, Mark. The lines are fairly decent. I took out some of the earlier data there to get a better read on the growth, especially the growth from 14 through 16, and then I noticed that the growth 16 to 17 was even higher. So I'm reading off of my graph here that the sales growth is running about 12% over the period of time. The earnings running about 22%, and pre-tax profit about 24%. I added the net income line to this graph. That's the profit after they've paid taxes, because I'm looking to see if there's any change between the distance on the pink line and the orange line. I know that this is really a balance sheet. When I'm reading it, starts out with sales, ends up with earnings per share, and the distance between pink and orange is telling me taxes, relative taxes being paid. If that distance increases, then the taxes are going up. If that distance decreases, then the taxes are going down. I'm noticing that Coherent does not do a fiscal year that matches the calendar. The last quarter, which is the second quarter for their fiscal year, ended, and I've circled it up there, it ended on 3/18. Am I reading that correctly? I think I am, 3/18. And I'm looking at the quarter. That means that the dot before it, the open dot after the 2017 dot on earnings, that's the dot where if in fact they're going to take a charge for repatriation, that's where it will appear. Unfortunately, I don't get those dots for these lines that I add in this tool. So I went to their annual report. They are taking a little bit of a charge, I'm not too worried about how large that charge is because I'm looking at the trend for these last 2 quarters, and they seem to be fairly consistent with the trend that was in place from 2014 to 2016. So I'm continuing to project from the most recent quarter there. I'm looking at a debt, looks to be manageable. They have made some purchases in the last year, so their debt is up a little bit, but they've indicated that was due to some acquisitions. I'm looking at a return on equity that's fairly decent. 15 is a good number, so this almost 20 in the most recent year is a very good number. And I'm looking at pre-tax profit on sales, which seems to be moving in an upward direction. That's a wonderful thing to see. Next slide, Mark. I went to Manifest. I looked at the graph that's at the very bottom of the Manifest page for Coherent. And I love to see this rising quality line. Focus just on the blue line, if you will. You see that quality hit a low back in 2016, and it's been rising very consistently month after month, year after year. It's been moving up. So that's a great thing. It's now into the top quintile. It's above 80, and that's an excellent thing. I'm looking at where the par was at the end of the last complete month. And so this data is 1 month old because today is the last day of July. Another piece of data will move into this graph tomorrow or the next day. So the par was down around 8% at the end of July. So I'm keeping that in mind. I want to see what the par maybe is going to be when I move on to my study. So next slide, please, Mark. I used forward PEs of 22 and 13. I'm getting a buy, upside downside of about 5 to 1, and a total return of about 16. But I'm looking at par. That's the one that's projected return on the SSG Plus. It's about 11%. I'm comparing that to the analysts' numbers, which are being captured and massaged by Manifest, and the analysts are at 11.2. I'm getting some really good validation for my SSG. I'm in good company. I feel that I'm looking at this company in the right way. So I'm fairly happy. Remember that the par at the end of last month was only 8%, so the par has moved up. That means the price has probably moved down a little bit. And I feel this might be a great time to capture some shares of Coherent. So I think that's my last slide, Mark. One more.
Nope, that's it.
Yes, that is my last slide. So I'm going to suggest we add Coherent, the laser company, the leader in photonics. I'm suggesting we add that to our portfolio.
Pretty cool. Thanks, Ken. Brings back fond memories. I know that probably 15 years ago, I brought that to the Securities Review Committee for Better Investing magazine. So I think I might go back and take a look at that article. Do a little nostalgia. All right, we're running at about 9:29. I'll try to wrap this up in 5 minutes or so we can move on and get to the Q&A also, the poll and then the Q&A. I like Ken, I also like to share, as Cy does every month also when he's here, where the ideas come from. This is what we dub our ivory soap screen at Manifest. It's basically searching for, among the companies that we cover, the ones that are in the top 1/2 of 1% based on the return forecast, which is the PAR, the projected annual return, in combination and basically equally weighted with quality. In other words, we want better companies at better prices. And when you hit the search results, entering that one single number in as a minimum, that 99.44, you end up with this as a short list of companies to study. I like a bunch of these. I mean, I would study and consider almost all of them. A couple of them make me a little skittish. Those with higher PEs and lower financial strengths might be ones that I would skip over right now. Like Ken, I do like to find a good company with a decent outlook and a decent growth rate and a relatively modest PE, and there's a few of them on the list that actually capture my attention. Bought some United Natural Foods after the announcement of the Super Value acquisition. It's taken a bit of a dive based on the uncertainty there. One of Ken's favorites that's been extremely rewarding to people that have followed the Roundtable, Simulations Plus. That's a good study and worth digging into a little bit more. I'm drawn to Skechers because I need a new pair of tennis shoes. Here's a quick look at Morningstar to see, what might be on sale over there. And I see a couple here that would grab my attention a little bit at least. Tata Motors, TTM. That could be worth a little bit of a closer look. I left the quality on there. You can see that somebody in the green room was asking about McKesson. I think that industry will be challenged, but it's not going to disappear anytime soon. Could be worth digging into that. Notice the Cardinal Health is also on this list, probably by virtue of that same price pressure. So there's some interesting companies here, along with limited brands, L brands, ticker LB at the bottom. So Tata probably jumps the most off that list. And then also taking a look at Hugh McManus's favorite way to look for companies. We've dubbed it Irish Spring, much like the Ivory Soap search, only this time we want to find companies that are trading relatively close to their 52-week low. And there's a number of companies. A couple of these also came up in the green room. Signature Bank is right there at the top of the list, trading very close to its 52-week low. And again, we recommended that if you want to study that in more depth, you probably should include the works of Eddie Elfenbein at crossingwallstreet.com. That'd be a pretty good study also to see what's up there. I know that Carnival Corporation is the stock to study for September from Better Investing, so that might be worth a closer look. Hugh likes to shop for companies that are within 20% of that 52-week low, and you can see that many of them fit this bill or in that proximity. And Skechers shows up here again. So I'm going to go with Skechers. I need a new pair of tennis shoes. I've always liked Skechers, so let's talk Skechers. Not exactly up straight and parallel. They can be a victim of recessions and darker economies. They actually did some restructuring back about 7 years ago, and that resulted in the E disappearing from this chart. The sales fell off. They closed some stores. They did some things, but again, coming out of that, they've actually done a pretty good job of managing their business over the last 5 to 7 years, and you can see that they have kind of restored up street and parallel. Along with all those challenges and some of that uncertainty, there has been a little bit of a price plateau for the last 2 to 3 years, so we note that. Many of you out there probably own some of their products or have shopped them or worn them in the past. Favorite among medical professionals for running around in hospitals. I know I've got 2 sisters that are nurses and very comfortable footwear for that. We've also got Susan and Kim that are retired nurses here as guest damsels, so I know that that's an important thing. And again, pretty well distributed as far as stuff that they cover. They claim to be number 1 when it comes to, and what were the definitions, casual and casual athletic and walking shoes and running shoes. They've got a product in all 4 of those categories in the number 1 position. But the thing that really leads me to them and kind of the discussion here tonight a bit is the reality that these guys, and sorry for the pun, global footprint, much like the company that Ken presented, these guys have a very strong international presence. Again, 60 to 70% of their revenues and their profits coming from non-U.S. Business lines. So they're fairly well entrenched worldwide and compete pretty significantly in places like China and Singapore, Latin America, and Israel, as shown on the chart. So they come up as a subject of conversation in all of the talk about the tariffs. And the uncertainty with respect to the tariffs has caused damage to some companies. I think these guys are among that pack. My personal opinion is a lot of the stuff is a lot of bark and less bite. Could be wrong about that, but I think that that we're basically negotiating to repair some conditions that have been less than optimum, and I'm sugarcoating, for 30 or 40 years in many cases. And hopefully some progress will be made. The tariffs do introduce a bit of uncertainty. Here's a look at the Skechers over the last 10 years. You can see that they have had periods where, again, after the restructuring and the realignment, they zoomed up pretty good in the midsection of this graphic. They probably got a little bit ahead of themselves, and they have, for that reason, ended up with this plateau on the right-hand side of the page. But again, it is fairly decent progress left to right on the chart, with a pretty good step down, again, probably tariff-related, on the right-hand side of this chart. Here's what they look like looking at the actual assumptions. We're talking about a $4 to $5 billion company growing at 8 to 9% with fairly consistent margins if you look beyond that restructuring period that we talked about. Again, fairly decent 7, 8, 9%, even potential type margins going forward. And for a retailer, fairly steady PEs in that mid-teens range, 15, 16, 17. Those type of numbers will lead you to a upper teens return forecast. And you can see that the return forecasted value line has actually jumped up fairly noticeably. Again, most of that is because they've dropped from $38 a share down to $26 a share. So it really is a situation with, again, keeping the long term in perspective. The tariff thing is probably overdone, overblown. Keep the long-term perspective. And one of the things that I find absolutely amazing, I wrote an article a few years ago talking about how a lot of the retail companies that we fear and dread as investors have actually been among the best. The Aeropostales, the Abercrombie and companies, and those type of companies have actually been among the best, most rewarding companies to shareholders. Well, here's another one. These guys have actually returned 18.7% annualized to shareholders for the trailing 15 years. So again, if you can get them on the dip and perhaps not be married to them, you don't have to treat them like one of your own children. It can be an opportunity. This is probably one of those opportunities, and I'm going to add it to the tracking portfolio. So Skechers, ticker symbol SKX. So with that, Ken, I think we can go ahead and launch the poll.
I think it's important to note that, boy, we sure have some interesting stocks presented here tonight.
Yeah, Mark, can you hear me?
I can hear you.
Great. Okay, here I am launching the poll. And folks, if you're on a tablet or a computer, even if you're on a phone, use your device or your finger and choose one of these for us here. I'm looking at the percentage voting, and we'd like to close it down when we've had 85 or 90% of our audience voting. We're up to 75%. So if you're hesitating, it doesn't cost you anything, and nobody knows what you voted for. So come out and give us a vote. Mark's going to try to audit the vote.
I send Christmas cards.
All right. I'm going to count to about 10 in my head here. We just hit the 85%, 86%. So come on, give us a vote if you haven't made a choice by this time.
Oh, you know it's a landslide.
I'm going to close the poll, and I'm going to share the results. Okay, and looks like we're going to add another position in Coherent here. Okay, Cognizant 15%, Coherent 60%, Iona 6%, Skechers 18%, and we have 1% of you that don't like any of them. So
well, that's not bad. That's pretty good.
That's pretty good. Okay.
Yeah, well, Coherent.
So I'm going to hide these results here, and
Herb, I hope you're not stunned, Herb.
No, actually, I'm pretty excited because I know that I have won a couple of the contests with some of my presentations. So hang on, people. Here, we'll see what happens.
All right.
That's right.
So Herb's aiming for the grandstand. He's shooting for the fence there on Ionis here. So we'll see how it goes. Mark and I and Cy and Hugh are going to be in various places throughout the next 8 or 10 months. If you're down around Oklahoma City, come join us on August 18th. Or if you're near Atlanta, come join Mark and Cy on August 25th. Our August roundtable will again be the last Tuesday of the month, August 28th. Southeast Michigan is becoming active again, and I'm going to be down in southeastern Michigan along with Mark on October 6th. That's in Troy, Michigan. Go to the website for more information. Mark will be in Washington in October. I'll be in Charlotte, North Carolina in late October. We'll both be in Pittsburgh in May, and at the National Convention, you should be able to meet all 4 of the Knights of the Round Table. All 4 of us have been invited to the convention this year, and we're crossing our fingers that not only can Cy make it, and he usually is able to, but we're hoping that Hugh's going to be able to make it as well.
We could quite.
Go on, Mark.
I was just going to say we could quite easily have a Justice League panel in Chicago. So,
no costumes, okay?
We might have to put the costumes on, Ken.
No costumes.
I will do just an additional plug for that joint meeting with the AAII and NAIC in Washington, D.C. in October. I've actually been digging into, many of you will remember, the Level 3 Investing book by James Clunan. He's the founder of AAII. And looking at that book in combination with George Nicholson's Investor Manual, and just basically building a case that these two firms, which are dedicated and focused on education and collaboration, and the way that these 2 books kind of come together and cement some really successful long-term investing concepts. So it's turning out to be some really decent research, and I really look forward to sharing that perhaps there and beyond. Cy and I are actually going to be talking about risk and what it really is in Atlanta in August also as part of a session. So fun stuff all around, and
I'll tell you, folks, if you're with a chapter and you're looking for a program in the spring, Mark and I have a few dates open yet. So if you want to give us a call or drop an email to us, we can arrange something if you're looking to put a program together. We will be trying to answer most of the questions that are on the website here. But before we do that, we're going to put an official end to this particular session of the roundtable. Boy, we came in within 2 minutes of time tonight, Mark. That's pretty decent, okay? And folks, don't leave after Mark does the sign-off. We will be answering your questions, and we'll try to get to as many of them as we possibly can. Usually, we're able to close the list down. So thank you very much for coming this evening. Herb, any final comments?
Just that you forgot the November 10th Stock Pickers Breakfast in Saginaw.
I forgot my own chapter's program.
We'll get that on the list for next month.
We'll put that on the list for next month here. Thank you so much, Herb.
Special
and Mark,
thanks.
any last comments, Mark?
Well, just thanks everybody. It's been a good run for 8 years. The cash flow in the Robertson household is better than it used to be now that college is over and a few things, and I'm enjoying investing in this stuff, and it's good stuff. So again, thanks to everybody for showing up. Special thanks to you, Herb, for filling in tonight. Sure. Look forward to seeing you soon, sir.
Anytime.
All right. Good night, everybody.
So